It's time for your personal bank show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to your personal bank show. And I'll tell you what, I'm going to encourage you, if you missed the last show, you should go to yourpersonalbank.com. Check it out. I talk a lot about the initial impact of the new administration in terms of how it's going to affect the economy, taxes, your money, retirement, that kind of thing. So again, I really strongly encourage you, if you missed it, check it out, yourpersonalbank.com. You can listen to any of the previous shows, by the way, at any time. Check it out, pass it on to others. Today, I've gotten a lot of real good feedback. I'm getting a lot of folks asking a lot of questions. It's really good. I want to touch on some of those that have come up, that I think more of the pertinent ones, I'll put it that way. And also, I want to, before I get into that, I also want to encourage you, if anyone has a question, because here's the number one thing I get all the time. I'll tell you this. Wow, this is an interesting idea. Again, using a high cash value policy. Again, we have companies that have been paying dividends for 6% plus, 25 plus years or longer. I have the charts of all the different top dividend payers. I can show you which companies have been doing that. And many of those companies have been paying dividends, have never missed since literally before the Civil War. Now, that's an incredible track record when you think about it. You think about it, companies have been paying a dividend every single year through the Civil War, through the Great Depression, through World War I and II. Those are tumultuous times, all right? And they never skipped a beat. And they're continuing to do so today, and have the cash reserves, A rated, all that kind of good stuff, well positioned to continue those dividends for the foreseeable future, okay? So they're built structurally for long-term cash growth, long-term, solid, consistent dividends. In fact, one of the things I run into a lot of the times when I talk to folks who are more sophisticated investors or who have invested in, and the big problem a lot of people today are facing, let's face it, was these extraordinarily low interest rate environment that we're dealing with. It's hard to get fixed income. It's hard to get any kind of consistent income. A lot of people turn to bonds and things like that, but the rates are just, bank. Look at the rates in the banks. I mean, what kind of interest do you get on money that's sitting in the bank? Checking, savings, CD, you name it. It's horrendously low. I see folks all the time with balances of 100, 200, 300,000 even of money in high interest savings account, quote unquote. I kind of laugh when it's high interest, and then I look at them and the interest rates are maybe 1% or 0 point something percent. Okay? That's common. Why is that person sitting on funds in a bank account and they're earning less than 1%? Well, it's because they want to keep their money safe. That's their number. A lot of these folks are retired or nearing retirement, but they want, and not all of them are. Some are they're more conservative. They just don't want to put their money in the risk, say the market or real estate or other things or cryptocurrencies or other things that are out there that, from their perspective, is just too risky. They're not comfortable with it, right? And you shouldn't do something you're not comfortable with. I mean, my gosh, it's your money, right? I know some advisors would disagree with that, but the reality is I don't try to push people into stuff that's uncomfortable for them. And the reason I do that is, well, like I said, first of all, it's your money. Okay? And who's to say what you're doing is not the right thing? But secondly, money is more about, you want your money to grow for you and all that good stuff. I totally understand that. Compound interest, I teach on that all the time. But if you're having trouble sleeping at night, there's things that are more important than money, isn't there? I mean, there's something called peace of mind. And I can tell you stories. I've been in the financial industry over 20 years, all right? Dealt with clients all that time, still do today, actively, on a regular basis. And I can tell you there were times where I would meet with clients back from, 01, 02, 03, when the dot-com bubble and then burst, and then 08, 09, and those areas where we had the Great Recession. And there would be people that would get statements on their retirement accounts or whatever, investment accounts, And they would say to me commonly, like, it's funny, it's usually the wife would say this, well, he won't even open the letters because he knows it's bad news. He doesn't want to look at the statements. Is that a way to live? You know, and if a lot of times you're talking about somebody who's retired or doesn't have the ability or desire to go back to work and try to replace the funds that were lost. Now, fortunately, in both of those scenarios I've shared, the markets and such did recover, and they recovered rather well and went well beyond that. But at the time, no one knew if and when or how long it would take for that to happen, right? There's no way to know. There's no way to predict. And for that type of person, that's extraordinarily stressful. And stress is the number one cause of disease, right? So that's why I go back and say, look, is it really, really worth it? Is the risk to you worth it? And should you put some of your money at risk? In most cases, the answer is yes. But for some people, I'm going to tell you, and this isn't necessarily older folks, oftentimes it can be a younger person. They just don't want to take on the risk. They're not wired that way. In fact, there's been study after study that's shown that if you give people the option of you have an investment that can go up 8% a year, but also could lose 8%, versus something that would just give you a steady 4%, something like over 80% choose the steady 4%. Because that's the way they're wired. That's how a lot of human beings are wired. I've seen other things out there, articles and stuff, and like I remember one, I forget who it was from, it was recently, big stock market investor. He's a money man, one of the big ones. And he said, you kind of, let's be real. If you're going to invest in the stock market, for example, and this is a quote from him, you kind of have to have a little bit of that gambler's mentality that, he says you just do. And if you don't have that, you probably shouldn't be in it. He's got a good point. Look, if you're comfortable there and it's working for you and you're not stressing out and that, fine. Now, should you diversify some of your portfolio, have a safer bucket for emergencies or opportunities? I don't think anyone would argue with that. Of course you should. But, I just want to understand it's okay. There are people out there, and it's a pretty significant percentage, because when you ask them these questions, where they feel more comfortable, really, and you don't push them, there's a lot of folks out there that just don't want to take on the risk. I'll give you another segment of the marketplace that is generally not too keen on taking a lot of risk, and I'll tell you who that is. Most people don't really consider this until it makes sense, but entrepreneurs. I'm an entrepreneur myself. I get it. You see, what a lot of people don't realize is an entrepreneur takes on a calculated risk, and frankly, and many times a significant amount of risk to start and run a business. Study after study shows something like half of small businesses, the Small Business Administration shares this information consistently and has for decades. Something like 50% of small businesses fail in the first 5 years. Now, different segments have different percentages. I get that. But, if you just take that right there, you have if you start a business, you have a 50-50 shot of losing all your money. Folks, that's pretty risky when you look at it right on the surface. And if you do build a successful business, economic things happen, COVID shutdowns occur, any number of things, something happens to you personally, or you have a health situation, there's any number of risks that can happen to that business owner, that's particularly a small business owner, that's risky, that involves risk to their income, to their financial future. So I can't tell you I can't even count how many times I've worked with, many of my clients are entrepreneurs, and I think a big part of the reason of that is quite simple. I'm one, myself. I've owned 4 companies. I've started 3. I'm in the process of starting a bank. I'm the chairman of the board of a bank in formation, as you heard on some of the promos and things. I've owned a retail business. I've started a construction company. I was a big sprinkler contractor for a while, commercial and residential. I owned a retail nursery business, plant nursery, that is. I've owned a real estate investment company. We've bought land, developed it, brought in the wells, the roads, built the houses, did the whole thing. I've done the buy and hold properties, rental properties, things like that. And of course, for the last 20-something years, I've owned a financial agency. So my wife calls me a Renaissance man because I always enjoy a challenge. And I think that's true of a lot of entrepreneurs. The comfort zone is not comfortable for me. Once I get into figure something out and get a system going and operating, it's working, then I start looking for the next opportunity or challenge. What else can I create? What else can I do? And that's just me. That's my personality. That's who I am. And that's okay. But I understand when I do those things, where I allocate dollars and time and money to a new endeavor or to build a business further, expand upon it or change it or whatever, there's risk involved. You know, I've gone through a bankruptcy many years ago, decades ago, actually. I've lost a business, okay? Well, if anybody, so I understand, that's what I'm saying, I understand the risks involved. And by the way, I share this with folks all the time. Look, if you listen to somebody and they tell you they've never done anything wrong, well, one of two possibilities, frankly. It's this, that they're lying. Okay, that's one possibility. Or they've just not done anything, right? So I've had a business failure, okay? So thankfully, it was decades ago, and I learned one of my greatest lessons was this. I had a business consultant that I'd brought on, and I'd been meeting with him for a couple of years. And when all this came down and the economy changed, and it was just there was no chance of salvaging or keeping this business going because I had too much debt, lack of experience, various things. It was my very first business. And he said, look, he says, I know you're frustrated. I know you're down, but he said, look, you have just earned your master's degree in business administration, your MBA, from the School of Hard Knocks. And he says, you'll learn from this, and this will be one of the most valuable lessons you ever learned. And he was right. We learn from our failures. We never forget the lessons we learn from our failures, do we? You know, successes we may or may not learn from, frankly. But you talk to any successful entrepreneur, and they'll tell you, it's from their failures, where they made mistakes, where they messed up, where they failed. That's where they learned the hardest and most valuable lessons that were never forgotten. So it's from those experiences that I come from, why your personal bank I find so powerful, because it eliminates a lot of that risk in people's lives and gives you control and reduces your taxes and all that. So as always, I'm going to encourage you to stay tuned in the next segment. We're going to talk about some of this things further, some of the questions that I get from folks, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to Your Personal Bank. And I'll tell you what, I was got a little personal there in the last segment, so I'll just say this. If you missed it, you missed a good step. You missed an awesome one, I think. If you want to go back and check it out, go to yourpersonalbank.com. You can listen to any of the previously recorded shows, like I said, anytime you want. Pass it on to others, that kind of thing. But what I was starting to say is, many of the questions I get asked about Your Personal Bank, how it works, this is interesting, this is intriguing. I'm going to encourage you, particularly if you're somebody who has like I said, many entrepreneurs I work with, folks that are independent, work on their own, 1099, stuff like that. I'll tell you what, this creates a level of stability in your financial picture that not much else out there can. And it gives you access to your money, liquidity, access, and you can access funds tax-free and all that. Again, how does it work? It's really quite simple. We set up a high cash value policy designed to grow. We have companies that have been paying 6% dividends or close to 6% dividends for the last 25 years plus. I'll show you the chart, show you which we have companies still paying that today. They're well positioned to continue to do that in the future, for the foreseeable future. Some of these companies have never missed a dividend since literally before the Civil War. That's powerful. And then we set up a bank line of credit. The cash in the policy is the collateral for the loan. It's that simple. Now, what's interesting, and it's a specialized area of lending. You can't just go down to your neighborhood bank and get this. But the bottom line is this. The interest you're getting charged on the bank line is less than the dividends you're earning in the policy. And I always ask this simple question. I say to people all the time, look, when you access funds from the policy, are you taking them from the bank or from the insurance company. And once most people understand they're getting the funds from the bank and it clicks, and they understand, look, I'm putting money into this policy. It's earning dividends. It's been getting paid close to six or better for the last 25 plus years. Expect it to continue to pay solid dividends going forward. The bank lines of credit today are in the 3s, depending on the size, the amount of funds and that type of thing. So I always say, look, if you're getting credited 6 or you're getting charged 3, what's your money doing when you access the funds? You're keeping the difference, right? So your money's still growing. That's what makes your personal bank so powerful and so unique. That's the response I get, or the number one question I get all the time is, why? Well, this is interesting. I want to learn more about it. Why haven't I heard about this before? And things like that. It's not a new idea. In fact, this idea has been around for decades and decades. I'll introduce you to companies, I said, have been paying these dividends since before the Civil War. That's not new. I'll introduce you to banks that have been offering lines of credit against these policies for decades, literally. So that's not new. Why it's new to most people, why they haven't been introduced to this idea or been exposed to this idea, is for the most part, it's been the exclusive realm of the wealthy. Big business, corporate finance boards, bank boards, those kinds of areas, okay? There's a lot of reasons behind that. And some of them have to do with knowledge, lack of knowledge of most advisors. Let's face it, until I got involved with some corporate finance and bank boards and different things like that, I didn't know anything about this. Okay, and I was one of the top, I got recognized for top 10 producer nationally, multiple years for some of the major financial institutions in the country. Okay, so I wasn't a slouch, is what I'm trying to say. I was out there doing stuff, generating business and clients and leading, one of the leaders in the industry. Didn't know anything about this. And the reason? I was dealing with what the industry calls a retail client, the average American. And generally speaking, that's pretty much anyone, roughly speaking, under 10 million in liquid assets. Okay? So if you've got less than 10 million in liquid assets and you're working with any type of financial advisor, it's highly unlikely, and that advisor works with folks with 10 million and less, typically, like most do. They don't have any exposure or knowledge about this either. So how would they introduce it to you when they're not familiar with it themselves? Okay, that's one of the reasons. The other one is, unfortunately, has to do with how the advisor gets paid. From a financial standpoint, income standpoint for the advisor, they get paid less doing these, because if you're maximizing cash, here's the thing you got to understand about these policies. Most people think of insurance as a death benefit protection tool strictly. And of course, it can do that, and it can do that job very well, but it also can be structured to maximize cash value. Think of a teeter-totter. Put death benefit on one side, cash on the other. Most policies have a large death benefit, small cash. Term, by the way, has no cash. So it's strictly a death benefit protection tool, right? We do the opposite. We flip the teeter-totter. We're maximizing cash, minimizing death benefit. And by the way, folks, I'll be sharing more information on this in the future shows, so I'm going to encourage you to stay tuned. But there's a very little known tax rule to change that's a major, they call it a Christmas gift. It happened December 31st in the COVID bill, that allows people to increase the amount of funds in the cash in a policy. This is the first major change of this type since the 1980s. So this is a really big deal. This will allow people to put more cash in these policies. Again, think of that teeter-totter, more cash than ever before, and minimize the death benefit. So now it becomes more of a cash accumulation, tax-favored cash accumulation tool than ever before. So everything we've been talking about and what we're doing with this, set up the high cash value policy designed to maximize cash growth, access it through a bank line of credit, and keep the difference, the positive arbitrage between what you're earning and what you're getting charged when you access the money. We're going to be able to increase that even further now due to this new tax law change. I'm going to be sharing some more information on this in future shows. I'm working on bringing in an expert or two possibly, but So stay tuned. I'm really curious, but what's really exciting is we're going to be able to implement this. Well, as we speak, by the way, they went in. The companies had to readjust their numbers, their illustrations, their policies, their contracts. All of them are doing it. There's a lot of excitement in the insurance industry, more than I've ever seen in my lifetime. And starting in early February is where most of these companies are up to speed on all this. So you're going to see some differences going forward. I'm going to encourage you to contact me at yourpersonalbank.com and to get more information. And if we've chatted before, if you looked at the numbers before, either through myself or through anyone else, I'm going to really encourage you to get back in touch, because we're going to be able to show you even better cash numbers than what you saw before because of this tax law change. And again, that's an exciting thing and a good thing for individual people who are doing this, who are investing funds or who are contributing to these policies. But again, what makes this so powerful, what makes this so unique, is the ability to then access funds through the bank line of credit. Remember, the cash and the policy is the collateral. You're not touching that cash. You're accessing the funds from the bank with the line of credit. And the bank is charging you less than the insurance company is paying you. So you're keeping the difference. Generally speaking, currently and historically, you can see about a 2 to 3% positive arbitrage. Now, 2 to 3% may not sound like a lot, but here's the deal. That's 2 or 3% interest you're going to earn, or keep, I should say, on money you spent. Now, if you just heard me, that should change your financial world right there. That is earth-shattering. That is game-changing. Remember, you're earning interest on money you spent. Stay tuned in the next segment. We're going to talk about that further.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. And I just left everyone, if you were just listening, thank you for staying over on the break. I left you with a powerful thought. I was sharing with everyone how to earn interest on money you spent. Now, I'm going to say that again in case you missed it, and then I'm going to reward those that stayed on, because I'm going to go into this further and answer some questions that I get commonly. You can earn interest on money you spend. It doesn't matter what you spend it on. Houses, cars, clothes, food, whatever. How do you do that? By using the personal bank concept. It's very simple. You set up the high cash value policy designed to grow cash, not designed to maximize cash, not death benefit. I shared a new tax law just took effect December 31st. That's going to allow us to increase that even further. So if you did look at this last year or prior, I'm going to encourage you to re-look at the numbers, or they will be better than what you saw before. Here's how it's done. It's quite simple. The cash grows in the policy that you contribute to a policy. It grows cash. It's designed to maximize cash, minimize death benefit. I always tell people, think of a teeter-totter. Put the cash on one side, the death benefit on the other. We're pushing the teeter-totter the opposite, completely the opposite of how most people view life insurance. Most of them are using it as a death benefit protection tool, strictly. And that's fine. It'll work that way, but it also can do other things like maximize cash. What we do is we flip the teeter-totter. We minimize the death benefit. And again, we're going to be able to do that even further than previously due to this new tax law change, December 31st of 2020, and increase the cash. So we maximize the cash. We have companies that have been paying, and still today, pay 6% dividends for the last 25 plus years. Never missed a dividend since before the Civil War. Is that a good enough track record for you? Folks, that's powerful. That's as good as it gets. They're A-rated, have tons of cash reserves, well-situated, well-positioned to continue those dividends for the foreseeable future, even with this low interest rate environment. I get asked that a lot. What about this? About a year ago, I think it was, one of the CFOs of one of the companies that we work with shared this thought. He said, based on our current cash reserves and our current client base, if we added no new customers, we could continue our current dividend rate for the next 100 years. Folks, that's powerful. These are companies that paid dividends through the Great Depression, through the Civil War, through both world wars, through every other thing you can think of, never missed, and are continuing to do so today. So we're pretty confident they're going to pay dividends in the future, and they have the money to do it. You see what I'm trying to say? So your money grows, right? It's going to grow, and it's going to grow on a tax-favored basis, by the way. Now, we access the money through a bank line of credit. We set up there's a specialized area of lending. There's only a limited number of banks that offer this. We can steer you to the banks who offer the best interest rates based on your situation, based on the amount of funds and things like that, and how we structure it. The bottom line is the rates are between 3 and 3.95. If you're earning 6 or close to 6, let's say, and you're getting charged in the 3s, when you access the funds from the bank line, what's your money doing? I think everyone I've ever asked that question to has given me the same answer, and that is, well, it's still growing. I'm keeping the difference. I said, exactly. You're keeping that 2 or 3% difference, or that 2 or 3% positive arbitrage. Now, this is the game changer. This is the earth-shattering difference. We all spend money, right? If you do it this way, you actually earn interest on money you spent. Normally, when we spend money, what happens to those dollars we spend? We buy an item, we spend the dollars, they're gone, right? Do they ever earn interest for us in the future? No, never, right? Here, you earn interest on it. Now, 2 or 3% may not sound like a lot, but how much do you spend a year? 30, 40, 50, 100,000 a year, typical household in America? Easy. Businesses spend more, right? Oftentimes. So think about this. If you pick up 2 or 3% on that, spending those dollars, isn't that just gravy? Isn't that like icing on the cake? It's extra. It's the cherry on top, isn't it? You're already spending the money, aren't you? It's not like we're changing anything. You're already spending the money. How about if we could get some interest on that money you're spending? Your personal bank can do that. Now, here's the last piece of it. And if this clicks, this is the game changer. This will change your financial future. You earn that positive arbitrage for the rest of your life. What if you earn 2 or 3% interest on money you spent every year for the rest of your life? What if that's 10 years, 20, 30, or more? How much more money would you have available to spend, to live on, to supplement retirement, or anything else it was you wanted to do? Folks, this changes the financial future of families, individuals, businesses, you name it. Contact me at yourpersonalbank.com for more information so we can look at your situation and look at how we can maximize and here's the beauty, most of the time we don't have to change much of your lifestyle. It doesn't impact you at all, but now you have more money. Stay tuned in the next segment. We'll talk about that further, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. We're rounding third and wrapping this up today. Today I've talked a lot about your personal bank, how it works, how you can earn interest on money you spent, right? How you gain control. What you're doing there is you're gaining control of more of your money. Now, why is that important? Well, I say to folks all the time, do you want more or less in retirement? I mean, say to supplement your retirement or just over your lifetime in general. Do you want more money available to you to spend or you want less? I mean, that's just a no-brainer. But do you think as we go forward, 2020 has taught me one lesson for sure, and I think it's taught a lot of folks this lesson, and that is we can't be surprised by anything. In other words, nothing surprising. I don't know what's going to happen. I wish I did. I wish I had a crystal ball and could tell you and could plan accordingly and say, look, this is what we expect over the next 1, 5, 10 years. As retirement planners, as financial folks, I mean, those are the kinds of things we routinely do with folks to try to plan for the future and assume they're going to have X amount of money available to live on for retirement, things like that. The problem we've got right now is, when you do that, you put in some fairly predictable things like what is inflation going to be, right? over the rest of your lifetime. Let's say that's a 30-year horizon or 40-year horizon or 20, I don't care. But whatever your time horizon is, what's inflation rate going to be? So we input an average inflation rate typically, those kinds of things. What are the tax rates going to be? We try to put in what's a typical average tax rate. And all the calculations, you've heard the term garbage in, garbage out, right? The numbers that come out the end to show how much you're going to have are all based on those input numbers. And to be fair, in my previous 20 plus years of my career, those numbers have fluctuated some, but not dramatically in the most case. The lone exception is, this extraordinarily low interest rate environment we've faced for the last 10, 12 years now. That wasn't predictable, I don't think, prior to the Great Recession, 08, 09. That's made a major impact on people's retirement, particularly in the fixed income side. If they were expecting a certain rate of return, let's say, on their fixed income, and of course, the low interest rate environment didn't create that. It means they needed a lot more to create the same end number. You see what I'm saying? Here's the problem we face today. People keep living longer, but what's inflation going to be like over the next 10 or 20 or 30 years? I don't know that anyone can answer that with a lot of certainty. I mean, we've certainly had more government spending and more government debt than at any time in history. That's a fact. We're in uncharted waters. How's that? And so is that going to create we saw in the late 70s a hyperinflation scenario, right? Where if you were in a fixed income situation, you had a CD, for example, you were getting great, where you were getting double-digit returns. But if you had to borrow, you had a mortgage, you were paying 21% interest rates on mortgages. Are we going to see a scenario like that again because of creating a bubble with too much debt, printing too many dollars, so the value of the dollar, every dollar decreases, right, versus a fixed cost of a good or service? Certainly, I mean, it's easy to make the argument that we could see that, okay? And I could easily see that kind of thing happening. Also, it may not happen. That's the unpredictable nature of this. So inflation is a really, really big unknown going forward, unlike it was even just a year or two ago. It was less of an unknown. I think it's a much, much bigger unknown. Let me give you another one. Taxes. Tax rates over history have fluctuated, but since early 80s, we've seen a fairly consistent tax rate. I mean, it's changed a little, a little bit in different administrations and stuff. There's been adjustments up and down to a degree, but no great major changes, frankly, since the early 80s. So for the last 40 years, we've seen a pretty consistent tax scenario. Is that going to continue? I mean, if you go into the Carter years, even, for example, which for some of you that are listening, you remember those days. It wasn't that long ago. The top tax bracket was 70%. Okay. Today it's in the high 30s. Okay. I mean, basically half, right, of what it was then. Now, there was differences in tax deductibility of different things and all that. I get that. But that's a dramatic change. Are we going to see another dramatic change like that in the future? Either whether it's incremental or all of it once, all of a sudden. A year or so ago, I would have said to you, I don't see it. Today, nothing surprises me. It's certainly in the realm of possibility we could have, our tax rates could double. Now, what impact would that have for retirement and putting money away? What about all these folks with IRAs and 401ks, for example, where you've been putting money away in a tax-deferred account? What does that mean? A traditional IRA or 401k means you're deferring the taxes now to then pay them later when you withdraw the funds. Well, if tax rates do double in the future, what did you just do? You created yourself a huge tax liability. Some people call IRAs and 401ks ticking tax time bombs, just so you know. So Does it make sense to have an alternative plan or an alternative? Diversify that. Does it make sense to have a tax-free bucket? You have a taxable bucket. Why not have a tax-free bucket? And if you want more information on that, there's a book called The Power of Zero by David McKnight. I encourage you to check it out. I think you can get it for free at the library. I used to say go to Amazon, but I don't want to support them as long as they do not support free speech. So please find other alternatives to find this book. It's one way we can fight back and protect and challenge, try to protect our civil rights, right? And that's another area. What kind of civil rights are we going to have? What kind of free speech are we going to have in the future, right? I'll give you one more. Social Security. You know, it's no big secret. Social Security is financially in trouble. And then, you know, through COVID and stuff, it's gotten worse because there were payroll holidays and things like that all occurred through the process of that. And again, I'm not here to argue whether it was right or wrong right now. That's for a different day. But the fact of the matter is, financially speaking, Social Security is on a weaker footing than it's been in a long time. That's the math. And I've seen some studies on it from the Social Security office, by the way. This is from the Social Security Administration, stating that if things don't get shored up, so to speak, something like in the next, I believe I saw the last 5-10 years, they'll have to reduce benefits to 80% of what they are today. So if you are retired or maybe a little bit younger retiree or not quite retired, you're going to be going into it in the near future, can you expect to get the benefits that your statements say what you're receiving now? Are you going to get those 5 or 10 or 20 years in the future? It's impossible to say. I don't think anyone knows. That's the problem. And if anyone says, yeah, I know what's going to happen to Social Security in 10 years, well, they're probably trying to sell you something, right? I mean, the reality is we don't know. And there's so many uncertainties. Our country is so divided. There's so many things going on politically and everything else that many of these things, like taxes, like Social Security benefits, any number of things, you know, the economy, the market, interest rates. Yeah, that's the interest rates I talked about first. They could be dramatically different 5 years from now or 10 years from now. All of those things could be dramatically different. How do you plan for that? Well, you give yourself, already mentioned that, give yourself alternatives. If a majority of your funds are in an IRA or 401k, you have significant future tax risk or future tax liability. Does it make sense to strategically minimize that or mitigate some of that and create a second bucket of money, for example, that doesn't have the same tax implication, a tax-free bucket? The answer I would say for a lot of people is yes. Your personal bank can accomplish that. Okay? Market risk. What's going to happen? I didn't even talk about that one, but can we predict what's going to happen to the markets going forward? There's uncertainty there. Does it make sense to diversify and have some of those funds in a more steady, eddy, consistent growth situation? Of course it makes sense. Okay? When we're planning for inflation and various things like that, your personal bank's very interest rate sensitive. You know, generally speaking, stocks, when interest rates go up, stocks do poorly. Fixed investments, when interest rates go up, they tend to do well. CDs are a perfect example. Your personal bank would be one of those. So again, you're diversifying your future interest rate risk in case interest rates go up. It just makes sense. So you're mitigating tax risk. You're mitigating market risk. You're mitigating future interest rate risk. Okay? And lastly, if Social Security benefits or income for you happens to be less in the future, because it certainly could be, well, that positive arbitrage you can create with the personal bank and the bank line of credit, the cash in the policy, earning dividends higher than what you're getting charged, interest, creates a positive dividend. Knows you can earn interest on money you spend. Means you'll have more money. And is that a good goal? I think anyone would agree with that. So you've enhanced. Maybe that's maybe that difference there might just replace the difference in Social Security benefits you could receive in the future, for example, or the difference in the tax rates or interest rates or any number of things that could, and very likely many of these things, more than one of them, could easily happen in the future. So I guess what I'm saying, I'm not trying to scare people. I'm not trying to cause fear or anything like that. What I'm trying to do is get people to think and not necessarily just continue to do the same things you've always done and expect the results to always happen that happened before. The results that happened last year or 5 or 10 years ago, or your parents, very likely your experience could be much, much different going forward. And we've got to recognize, just like any entrepreneur does, like I've said this many times, I'm an entrepreneur. When you start a business, there's risk involved. It's what's called calculated risk. You calculate the risk, and you determine whether the risk is worth it or not, based on your calculations. When we're doing a retirement plan or planning for retirement for somebody, we're assuming a certain set of parameters. The problem is the interest rate, the future interest rates, tax rates, and various other things that could happen could be dramatically different than the input that's happening. So by creating that additional bucket, that tax-free bucket, that bucket, the consistent steady eddy, the market, eliminate the market risk bucket, creating the positive arbitrage bucket, so you'll get more money out of it. Even if you spend some dollars, you'll still earn money on it, so you'll have more overall. All those things just make sense. So contact me at yourpersonalbank.com for more information. Be happy to discuss this with you, answer your questions, and see how you can create this bucket of money. Take more control of your money. Give you some options. Give yourself some options. That'll reduce your future stress in case things do get a little bit out of whack. I mean, I think anyone would agree, 2020 was a pretty crazy year. It was a pretty rocky year for a lot of folks. And a lot of stuff got out of whack. And we just don't know where it's going forward. And we don't know the end result of where all these different things, there's a lot of change on the horizon. And some of this change will be good. Some of it's going to be bad, probably. But we just don't know exactly what the change is going to be and the total ramification of it. So as always, stay tuned to the Your Personal Bank Show. Contact us at Your Personal Bank for more information. Be happy to talk to you and look forward to enhancing your financial future.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.